Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and this is the market update. During the week, today is Tuesday, it is 5th of March and we're gonna take a look on the last news, what was the last updates related with the market and how these last events are affecting the global market. You got on the screen right now the update of today, the one I publish every morning in ATFX Connect blog. You can take a look here on the most fundamental events, but we're also gonna take a look on the charts to review everything from a data perspective, macroeconomics perspective, and also with the technical analysis view. So let's start with the last comments. Yesterday we got important this week. The most important dates is gonna be Thursday and Friday. I just had also on the daily update comment at the end. I say finally remember that this week we'll have strong macroeconomic events. Here is a reminder of the most relevant data to be released. Tomorrow we got the GDP of Germany. We also have the PMI index from United Kingdom. We got the PMIs of Europe today. I'm gonna make a comment on those ones in a few minutes. Also from Japan and from China. We got the first draft of ADP non-farm employment chains and Powell speak and the job reports. Canada interest rate decisions also today. But tomorrow is when we're going to have factory orders from Germany, interest rate decisions from Central Bank of Europe, deposit facility and monetary policy statement, and Christine Lagarde's speech. Also the trade balance for the United States. We're going to also get the initial job claims and Jerome Powell speech. And by Friday, Germany industrial production, PPI, and also the GDP of Europe Q4. The confirmation of GDP of Europe Q4, the review of the last numbers published a month ago. We also got the earning per hour, non-farm payroll, and unemployment rate for the United States. This is the ones that are gonna probably cause more. I would say between the speech of Jerome Powell on Thursday and non-farm payrolls on Fridays when we're gonna see probably the pike or the top of volatility we can expect this week on the market. Also on Saturday we got CPA and PPI from China published during the night of Friday to Saturday. So saying that, let's take a look at what happens during the last 24 hours. We got yesterday Raphael Bostic from Federal Reserve made a hawkish remark, comment speculating that Fed will take a break following just one rate hike in the current quarter, while the US dollar, the XY, did not respond to those words by rising in value. US bonds did react. Let's take a look on the reaction. So again, the comments from Baltic, it was like pushing away the interest rate cuts action, which we was expecting to happen in March initially back in December. And by now, the market is discounted that this interest rate cut could happen by June or July. Even initially the idea was 4 interest rate cuts, 4, not only one but 4. And right now at the moment, the market is discounted that maybe perhaps we only gonna see 2 interest rate cuts this year, 2024. Now, regardless if that happens or not, what I was mentioning is the market, it was not responding. The main response we could expect is from a hawkish comment from Baltic. It was a dollar index rising up, because if interest rates are actually be on hold or in standby for longer than expected, and it's gonna keep the interest rate highs at the current levels for longer than expected, and therefore probably the money gonna flow to United States assets, financial assets, particularly bonds, particularly bank deposits, because the interest rate's gonna remain high. If that's the case, dollar should react by rising. It didn't happen. It happens. Nevertheless, the dollar index was rising up. Now we can see that the yield is actually falling, and therefore is discounting this action of the interest rate cut. So if the yield is falling, means that by default the sentiment of the market is a low interest rates from now on to the future. So therefore is going in line with the interest rate cuts feeling on the market. Is 10 years bond. We're gonna take a look on 2 years bond, and as you can see, it's also dropping back the last few hours. going to the zone of 200 moving average, which could support the price for a while, even about 450. We are facing right now the 2 years US bond. So therefore we can see that we got certain indications that if the bond is rising back again, it means the interest rates probably could rise again and make the dollar high. Still, even when the dollar is not responding to this movement, is also neither losing the support levels. Let me show you the dollar index right here. And as you can see, it's still dealing with the 2 moving average, 200 moving average period. And you can see that it's resisting about 350 points. Right now we are in 103.82 points. And the moving average, 200 moving average is there. We also got the neckline there, as you can see. And therefore we can just expect that maybe the support line hold the price for a while there. And if the dollar index is not dropping below those levels, we still could expect that the price could actually come back again to higher levels next to the top records done during the last year, which is close to 108 points. Still the projection, still the bullish pattern is active. It will be discard if the price is dropping below those levels. So far, it still is there and is still active. What is surprising, related with the dollar and related with the bond and related with the value of the main currency, world currency with this dollar, is the value of the gold. Take a look of what is going on in gold. There is 2 factors pushing the gold up in this level. I mentioned those 2 factors in the daily report. The main factor is economical factor, which means like if the interest rates is keep moving forward and the dollar is gonna lose power and therefore value because they're gonna reduce the price of that dollar, reducing the interest rates. In that case, gold will rise because gold is actually the hedge that most of the people use to cover the lack of value in the deposits in dollars. So therefore, if the dollar is losing value, gold gonna rise to cover that gap in the dollar's value. And that's what we are watching right now. We're watching a gold that is rising $2,130 per ounce. Is getting away from the resistance that you can see here around $2,050 per ounce. And right now we are in 2,130. Almost top record if you consider as a record the ones that we saw. It was a kind of flash up movement on gold, 4th of December 2023, and it's rising back again. Second factor that could justify this movement in gold is geopolitical risk, which means comments made by the ex-president of Russia yesterday, Medvedev. He was mentioned that Russia consider, in his opinion, in his eyes, the relation between Russia and United States are even more risky now than it was in the 60s during the missile crisis of Cuba missile crisis. So therefore, it means like we are in a worse situation than then. What else? I was mentioned also the PMI. Let me share the whole screen with you. PMI, the index on manufacturing and services from Europe and from Asia, it was completely different. The case of Asia, the first to come out were the Asian ones. Japan present a PMI service index above expectations at 42.9. China, on the other hand, had a service PMI of 52.5, below expectations, but still above 50, which is the ones that indicate expansion instead of contraction. And finally, from the Asia side, Hong Kong present a manufacturing PMI of 49.7, indicating economic contraction. From Europe's side, we got also PMIs published this morning. And I would say the betters, it was the ones coming from Sweden, Spain, and United Kingdom. Those are the ones are about 50. Rest of them, let's take a look to the calendar so you can see by yourself. Rest of them are below 50, which is these ones. 48 in the case of France, 46 in the case of Germany. We also got Europe 50.2. So all of these are below 50 and indicate also contraction, even when they are above the expectations. But it still shows us a clear contraction on the economic activity, manufacturing and services in Europe. what else? Compared with the previous month, industrial production in France fell by 1.1% in January, above the market estimates of 0.1% decline. In contracts, there was a 0.4% growth the month before. The PPI released a few minutes ago in Europe. By the time I was published this report, it was few minutes ago. Already it's hours ago at the moment. Again, shows significant declines. In January, PPI fell by minus 0.9%, making the annual rate minus 8.6% year to year. This will mean that inflation is not correcting, but could even be plummeting, reaching a few months deflationary situation in a few months, which could lead to a severe economic recession. So again, anytime we see these PPIs dropping in a negative zone, we cannot discard that we are under deflation risk, because PPIs are the pre-indication of inflation, and if they are negative, means the inflation is not normalized itself. It's actually gonna start to drop or incline to a negative band. So according to data released today, core inflation in Japan capital reaccelerate in February above the central bank target has the impacts of government fuel subsidies. This was an indication that the criteria were being met for the end of negative interest rates. The Tokyo Core Customer Price Index, CPI, which is a leading predictor of national statistics, increased 2.5% in February over the previous year, in line with market expectations. So it means that if actually inflation is not disappearing in Japan, particularly in Tokyo, we could even also expect that at some point Japan will apply the contractive monetary policies, and then they will increase the interest rates, and therefore these massive three, I will say, let me show you 1, 2, and 3 tops will turn or could turn back down severely. Because we are right now in the top maximums of the last 30, almost 40 years, from the 80s, 90s till now. You see, this is April 1990. So April 1990, that's 34 years actually, almost 34 years since then, and we are reaching those levels right now. So again, we are very close to 160 yens per dollar. The relation dollar-yen 160 means we will face the most top record in the last 30 years, and therefore probably super strong long-term positions could open short on those levels. And what else? I think that's all. There are two main reasons that the gold is boosting. We already explained this. We already reviewed the calendar. I think that's all for today, because overall there is no much microeconomical data to comment today on the top of that. So I think this is all, but we need to keep an eye on the numbers, because as I say, Thursday and Friday is when we're gonna see the top record on volatility. Thursday mainly focused on Europe, so take a look on European euro dollar. By the way, I didn't show you euro dollar pair, I believe. So take a look on this pair, because it's the one who's gonna be moving. As you can see, my long-term chart is indicating also a clearly bearish channel, and again it's targeting 105, 105 the main first stop, and the next one, and the natural correction I think is gonna take us below parity of 1 in euro dollar. Thursday, comments from the Federal Reserve. No, sorry, Thursday, we're gonna see the interest rate decision by Central Bank of Europe, and also Christine Lagarde, President of Central Bank of Europe, speech. And by Friday, we're gonna also get the non-farm payrolls, unemployment rate, and labor market report from United States, the first biggest economy, and also the first reason why Federal Reserve could decide to cut interest rates. If the labor market is actually showing negative results, it's showing an increase on employment rates, also an increase on decrease on non-farm payrolls under the expectations, and so on. If the numbers mainly looks weaker in labor market, then therefore Federal Reserve probably gonna get one strong reason to cut interest rates sooner than possible. That's all. We're gonna keep monitoring the market and the situations, and I'm gonna keep sharing my comments with you. If you are not, let me remind you, if you are not subscribed, please give me a thumb up, subscribe the channel. And also, if you want to request any particular market report, you got my personal details here. You can send me an email and I can also add you on my newsletter. So it's not only the update I publish on the website ATFX blog, Market Snacks, but I also send by email a newsletter every morning completely free for everyone interesting, ATFX clients and everyone interesting on this market report, okay? Take care and see you in the coming next market reports. Bye bye.